Hi everyone, in this video we're going to be taking a look at Chapter 7, and in Chapter 7 we're going to look at the concept of internal controls a good bit, and this chapter has cash and internal controls kind of as the title. And when we talk about cash in this perspective, we're going to be talking about kind of internal controls around cash. Specifically, we're going to spend a good amount of time talking about bank reconciliations, which are an important accounting internal control analysis process and methodology that we do. And we're going to learn about those, and then in the homework, etc., we'll get a lot of practice. So, okay. So let's begin our discussion here with just an overall talk about internal controls. We've talked a bit about internal controls in previous chapters, but here in Chapter 7, we really kind of highlight this concept, and a reminder that internal controls are the policies and procedures that a business can put in place to basically prevent errors, prevent fraud, increase accuracy, so on and so forth. Compliance, you might have to have certain internal controls in place, best practices, all those kind of things. Some of them are very accounting specific, like bank reconciliations that we're going to learn in this class. But internal controls really is a concept that applies to the business as a whole, and different departments can be responsible for different types of internal controls. For example, when hiring employees, a good internal control to have in place is to do some sort of vetting of those employees, maybe a background check. Maybe that's an important thing in internal control to have in place. And so those background checks most likely are not going to be performed by someone in the accounting department or finance necessarily. It's probably going to be someone more on the human resources side. But regardless, those are internal controls, and they do promote the protection of assets for the business, encouraging effectiveness and efficiency of operations. If someone does have a criminal background and they have been multiple times been arrested for fraud or something from a business, then even though that background check was done by HR, that really is maybe the result would be that it protects the financial standing of the company still. So again, the concept of internal controls is very broad and applies to businesses as a whole. It's not just an accounting specific kind of practice or item. There's something called COSO, which is the Committee of Sponsoring Organizations, and it's this organization that has put out this framework to kind of guide internal controls and how they work together. And they've created these concepts of the control environment, risk assessment, control procedures, monitoring, and information and communication. So I'm not going to spend a lot of time talking about this. You may have one or two multiple choice questions that sort of refers back to some of this information. But if you continue on in your accounting education and you take an auditing class at some point in the future at a four-year university, we don't offer auditing. It's more of an upper division type of class. At Butte, we don't offer auditing specifically, but COSO is kind of a driving framework for how you would design an audit and an audit assessment, doing an assessment of the overall control and control environment, risk assessment, all these things would guide kind of an overall view of how strong the business is from a procedures and policies standpoint. So this just talks about internal controls being present, causes errors to be identified automatically or quickly. Segregation of duties is really important as a concept, and when it says you have good internal controls, you have duties that are segregated. That is probably the most important internal control that I've seen in my career. And really the idea there is just that you don't want one person doing everything. If one person is doing everything and they have control over all the different aspects of a business, from the accounting side to the money, collection side, the billing, the reporting, so on and so forth. You really increase the risk of something going wrong there. So it's much better to have different individuals responsible for different parts of a process, and the checks and balances that provides is a key internal control. And here's just some examples of different types of internal control activities. So as we talked about, segregation of duties, physical controls. I mean, these could be things from putting a lock on the door, so that the business doesn't get broken into, to different types of physical controls. HR controls, like we talked about, background checks, etc. Having independent internal verifications of things. And this is, like I talked about before, the audit process comes to mind here and is an important part of business operations, etc. So a whole list of things there. Okay, which of the following is not a purpose of internal controls? Well, reliability of financial reporting is. Effectiveness, I think I can see right away. Tax evasion is probably not what we're shooting for. Effectiveness and efficiency of operations, yep. Compliance with regulations. Tax evasion without getting caught is not what we're aiming for. We're aiming for integrity and transparency and accuracy, lack of fraud, not more fraud like it's talking about here. So again, internal controls is really an umbrella concept that encompasses every part of a business. We're going to talk about cash controls in detail. And the reason why we kind of hone in on cash is, as it mentions here, cash is the one asset that's readily convertible into any other type of assets. It is the thing to steal, right? You don't necessarily aren't worried about the theft of certain machinery and equipment, etc. Maybe things that are heavy and you can't just sell them easily, and so on and so forth. But if you have cash, if there's some way that a thief can get cash out of a business, that's what they're going to aim for. And so we want to have really strong controls around cash. And some of these things can look like having, the issuance of receipts, having cash registers, for example, having individuals assigned to specific cash registers, using deposit slips at a bank, and having an accounting department that's kind of separated from all these other processes. So again, segregation of duties so that the accountants aren't actually touching the money or depositing it necessarily. They're more so just focused on the accounting side. Okay, so when we talk about cash receipts, typically we're talking about cash, like actually receiving money at a cash register. And a lot of times nowadays, especially, credit sales is probably more of maybe a higher proportion of sales, people purchasing things with a credit card, for instance, and so on and so forth. So cash sales or credit sales are the two sides of cash, incoming cash. And then when we talk about outgoing cash or cash payments, we're going to be looking at the payment of invoices and making sure that those payments are legit and that they're properly issued, so on and so forth. So that is especially in terms of the cash payments, this is a very common area for fraud, where you see fraudulent invoices being paid. If it's a very common way and an easy way to get money out of a business is for that business to pay for something. And if the business is paying for something that's not legitimate, then that's what we're trying to basically prevent with good internal controls. And so two key concepts here in terms of cash payment controls are processes in place to ensure that all transactions are authorized. So there's some level of authorization that needs to occur and they've been approved, etc. And the cash, another idea here is trying to take advantage of discounts. So a lot of times when you pay quicker, so you might have an invoice that will say, if you pay us within 10 days, we'll give you a discount, etc. And so not only are we trying to prevent fraud from happening, but we're also trying to ensure that we're taking advantage of the discounts when possible. And those are both things that can be done through the use of a good internal control system. Okay, we have this idea here of cash over and short, and the idea with this cash over and short concept is that, especially in a business where there is actual money, not credit card payments and stuff, but there's a lot of money being paid. There's money, there's cash going in and out. There's a cashier collecting money and giving it back, etc. And occasionally, as it mentions here, cashiers will make an error because it's just human. The human is there at the cash register, making sure that the right amount of money is given to the customer and the right amount of money is collected, etc. And that's so. I mean, we would like to reduce the occurrence of any kind of errors to as small amount as possible, but it's not realistic to assume that no error will ever be made by a person at a cash register. So, as it mentions here, for small differences, small errors and variances, we're going to record these discrepancies in an account known as cash over and short, and then we review the balance of this account as it's, because it could be either too high or too low. Over or short is is indicating that sometimes an error on the cashier side could give the customer too much change back, or sometimes they could give them too little change back, for example. And so the errors could happen both with cash being higher than it should be or lower. And hopefully they're small differences, like I said. And we're going to aggregate all those differences and then review those at the end of the month. And we will kind of adjust to clear out those overages on a recurring basis, usually, at the end of the month, for example. And here is an example of a problem like this. So if we suppose a store had cash sales on this specific day of this amount here, but at the end of the day, when we go to count all the money in the drawer, we're missing a penny, right? And so we don't really care. It's obviously not worth the effort to track down. So then that's where we use this cash over and short account to balance, revenue was this is what we should have. For some reason, our cash in the drawer is not equal to that. And so we just use this cash over and short account, 2 debits. Now it's going to add up to equal the sales. And we just, we're missing a penny. Not a big deal. But we want to make sure that if we didn't record this, our balances, we would not balance. And as we've learned so far, in accounting, we want to balance even if we don't know where the cash went. We need to capture that variance somewhere so that we can analyze it. All right, which of the following is not a good rule for cash controls? I think overstating the cash balance is going to be the right answer. We don't want to ever overstate anything, really. That just means we're making an error. But these other ones here, recording cash immediately when received, is important. We don't want to have some amount of cash sitting in a random drawer somewhere, kind of a situation or something, which I actually have seen at a school district before, that they had someone collecting money in their cafeteria and building up thousands of dollars that was just in someone's desk drawer. So that was a real red flag type situation. So don't do that. We need to protect cash when it's on the premises, so it should be in a register, in a safe, etc. And we should be making regular deposits of that cash to the bank as regular as we can, so that we don't have a buildup of cash just sitting around somewhere, even if it's in a safe or anything. We want to get that into the bank. Okay, bank reconciliation. So as I was mentioning when we opened up this lecture, we're going to hone in on one key internal control, and that is the bank reconciliation process. And basically what we're doing with a bank reconciliation, and anytime you see the word reconciliation, what that represents is that we're going to be comparing 2 items. Typically, we're going to be comparing the balance that we see in our accounting records to some independent source document, in this instance with the bank reconciliation, that's going to be the bank records or the bank statement, for example. And so we'll be comparing what our general ledger cash account says versus what the bank statement says, and we expect to see some differences for reasons that we'll talk about here in a moment. But we expect to see those differences, and what our reconciliation is basically a breakdown of all of those differences, so that when we look at those two different data points, again, our cash balance per our accounting records and the cash balance per the bank statement, for example, when we look at those two data points and they don't agree, our reconciliation is going to highlight all of the reasons they don't agree, so that we can better understand, what those differences are, make sure that they look okay and accurate, and that they are not something that's an error or some other type of item like that, essentially. Okay, and as I mentioned, some of the reasons that you're going to have differences, and we'll be looking at these in detail and doing homework problems to figure these out as well. But some of the reasons that we'll talk about for those differences, which we will call reconciling items, can be things like loan interest charges, repayments of a bank loan, bank charges, EFTs or electronic fund transfers, so like automatic cash payments, and non-sufficient funds checks, NSF checks, which you might have heard of the terminology bouncing a check. That's what this is representing. Basically, someone writes you a check, a customer, and then you go to deposit that check, and the bank says, "Oh, sorry, this check is no good. This customer doesn't actually have that money." So that can be a reconciling item as well. Some other reconciling items: interest deposited directly into the account. So if you're earning money in your bank account, your bank balance can increase, and you're not going to know exactly what that increase will be necessarily without looking at the bank statement, for instance. Payment from a customer deposited directly into the account, so maybe they paid the bank on, the bank is collecting payment from a customer on your behalf, or again, some automatic cash receipts from other accounts, etc. And again, this is what we were talking about here, comparing these books. This is the GL balance per bank statement. This will be the bank balance. And then another thing that can happen is, there can be errors as well, whether we made errors in our accounting records or possibly the bank could have made an error. And so when we're doing this reconciliation process and trying to understand these differences, sometimes we'll shake out these errors and be able to correct those. So that's part of the process, as well as some of these differing items that are just timing differences or things of that nature that just you recorded on the GL, for example, but it's not like I'll give you an example now. We'll talk about this more in detail. A timing issue that's very common is when we write a check, for example, from a company to pay for something. When we do that check and we put it in the envelope and mail it out, the accounting transaction is to reduce cash when that check is printed. So we don't have a checks account necessarily in our books, in our general ledger. We just reduce cash. Checks are treated the same as cash, essentially. But the checks aren't actually cash, and they're not going to reduce from the bank balance until that envelope with the check in it, arrives at the vendor, and the vendor goes to the bank and deposits, and the whole process of the bank clearing that check is finalized. Then, after that process occurs, the cash in your actual bank will decrease. But we record the reduction in cash the minute that the check is printed, but the bank only reflects the reduction in cash when, like I mentioned, the check arrives at the individual who's going to receive it. They go down and do their thing, and they deposit it, and the check is analyzed by the bank, and the whole check clearing process occurs. So you can understand that those can be relatively different time frames of happening immediately versus the bank clearing a check can happen. It's dependent on when the person goes to the bank. So maybe it gets lost in the mail and you have to resend a check. Maybe it could take a month or something. And so we'll see some of those instances arise. And that's not necessarily an error per se. It's just a timing issue that may cause, if it has been a long time that the check has not been cashed, it may signal that we need to reach out to the vendor to ensure that they actually received it, etc. So it can spur on some activities that we need to do as on the accounting side to ensure that the payment is getting where it's supposed to be. But sometimes maybe the vendor just says, oh yeah, we got the check, we just haven't had the time to go down to cash it yet, and it's just a timing issue basically, and not an error per se. Okay, so here we've got an example of a typical bank reconciliation. So you can see, again, this is not a financial statement. It's not the income statement. It's not the balance sheet, etc. This is just a process that we do and a technique that we use in order to understand the differences between the cash balance per the bank statement and the cash balance per company books, or in other words, what's in the general ledger essentially for cash. And so you can see some things here, a whole number of items like we just talked about can come into play. So it's not typically that there's just one reconciling item. Instead, there's often multiple reconciling items that have to be analyzed and accounted for individually in order to arrive at adjusted balances that are equal. And that's the goal, is that we get these balances equal, and then we understand what the differences are that make them unequal. So we pull out the differences, essentially adjust for them, and arrive at equal balances. So this is kind of your goal when you're doing the bank reconciliations, is that you arrive at the same balance for the bank and the books. Okay, so let's talk about some examples of these reconciling items and how they are dealt with on the bank reconciliation. So here we've got unrecorded deposits from the bank statement. So here it says, from time to time, the bank may automatically record a deposit in the company's bank account. And this instance here, we can see here's our general ledger for cash, for example. And then here's a bank statement, for instance. And you can see they both start a $5,000 balance. You can see that we added a $300, a $500, and a $700. Oh, I'm sorry, we paid $300, $500, and $700 payments. So our balance in the ledger comes down to $3,500. And then on the bank side, we see the same thing. So here's the $3,500 and the $3,500. But then the bank paid us $5 of interest for having cash with them, essentially, and that payment just goes directly into the bank balance. So if you weren't, looking at the bank statement or somehow otherwise logging into an online banking portal, etc., the only way you would know that this $5 difference exists here is by analyzing the bank statement and seeing, oh, the bank put $5 into my account, and I didn't know that until I did this reconciliation process, for example. And then in order to get this to adjust appropriately, or to be where the balances are the same, we just add that $5 in on the book side, and you can see that we arrive at $3,505 as the total for both. Anytime we make an adjustment on the book side, like we did here, we're going to want to record a journal entry as well, because that really did happen. We really have extra cash. We really did earn revenue. This is not just a timing issue, for example, like we talked about previously with checks that are waiting to be cashed. This is us just not having recorded an accounting transaction and not knowing that it occurred until we saw or completed our bank reconciliation, basically. So the steps here with the bank reconciliations is to complete them and then to book journal entries. Typically there will be numerous accounting or reconciling items and numerous journal entries. This is just one example of that singular type. So that was the bank putting money in. The bank can also take money out sometimes for bank service charges, basically, or different things. And so you, again, might not know that the bank took $50 from you until you actually look at the bank statement and do your bank reconciliation. And then you realize, oh, there was a payment that we made to the bank, really is what happened. But the bank just automatically withdrew that. You didn't click the button. It just happens automatically, essentially. And these are called unrecorded charges from the bank statement. And the way that we deal with those is very similar to the cash received from the bank. But in this instance, we're going to want to deduct those amounts from the book balance to bring it down to a matching total. So previously, when we earned interest, we added the $5. But here, if the bank took money from us, we need to deduct that from our book side in order to get the balance to reconcile. And then we again do a journal entry. This time, we're going to record an expense, not revenue, like we did for the interest, and a reduction in cash because we paid the cash. We just didn't know it yet until we did our bank reconciliation. Okay, non-sufficient funds checks. As I mentioned previously, you might have heard the term bounced checks or bouncing a check, and that's essentially what we're talking about here. The idea is that the customer is buying something from you. They write a check and issue it to you. You take the check to the bank and try to deposit it into your account, but the bank analyzes that check, and through whatever they do on their back end, they become aware that the customer who wrote you that check actually doesn't have the money to pay it. And so in your accounting records, you here, let's say it's this $400 check, you write the $400 down, in your ledger because you don't know it's a bad check yet. So you say, oh yeah, we got $400 of cash. But then you go to get your bank statement later and you realize, oh, see, here was the deposit that would have matched up to what you showed, $3,900. But then the bank realizes later, oh, this is a bad check. So they remove that amount. They send it back to you basically and say, this is not sufficient funds. And a lot of times they also charge you a fee for having to do that. So not only do you not get the money that's owed to you, that the customer told you their check was good, but it wasn't, they also hit you with a penalty. So you kind of get it double bad sometimes that way. So that's an unfortunate situation. From the bank reconciliation perspective, again, we thought we had the cash, but we really didn't. It was a worthless check. So we need to reduce that check amount, and just like the bank did, from our accounting records and say, okay, well, that's not cash that we earned. That customer still owes us this money, basically. And then also we have to deduct the service charge that the bank charged us as well. Here you can see they match up. And then again, if we're making any adjustments on the book side, we have to do a journal entry. And the journal entry, especially if it has the bank service charge, we're going to do two separate types of entries here, with the first portion being a reduction of cash because we thought it was cash. We thought we could cash the check, but we couldn't. And we're going to instead put that to an accounts receivable, right? Because we're still going to want to try and collect this money from that customer, and we need to get a hold of them and tell them that they bounced this check, that they still owe us this money, and that we need to be paid. And then on this part, we're just recording an expense and a reduction in cash because the bank took this money from us because they had to try and process and deal with the non-sufficient check on their end. So not a good situation, but think about it there. Yeah, the AR is recorded to reflect the fact that the customer still owes us that money. Okay, let's look on the side of more timing related instances, and we're going to be doing these reconciling items on the bank side more. And these ones won't need a journal entry either. We'll kind of see that here as we go through. So in this example, let's say our company, we make a deposit in the bank, maybe perhaps using the night deposit box. So here you can see $1,000 deposit, and it might take a little while for the bank to record that deposit, maybe the following business day in the next month. If you do this on the very last day of the month and you're doing your financial statements on June 30th, and then maybe on July, they actually show on the bank side when this deposit happened. There's just a little bit of a time lag sometimes with deposits. It's not as extreme as an outstanding check, like we mentioned earlier, where you have to mail it to the recipient. The recipient receives the check, goes to the bank, has to do the whole process of cashing that check. This typically always processes within one day, but especially if the day is the end of the month and you're doing your cutoff of your financial statements, then you can kind of run into this issue. So you can see here on the bank side, we have the payments for 300, 500, and 700. That all matches up to give us an ending balance of 3,500. But then this one little transaction you did at the very last minute to add $1,000 deposit to the bank or to the cash account, and then the bank has not recognized that yet here. So on the bank reconciliation, as I mentioned, we're going to be putting these on the bank side, so over here, and we just need to add those in so that we can understand that, okay, well, that's why there's a difference, and this amount should be processed, in the next business day or two. So we add that balance in to get those amounts, the adjusted balances, to agree. Okay, now let's talk about so that was outstanding deposits. Now let's talk about outstanding checks. So that's outstanding payments, in other words. And this is the situation I was talking about with checks that are issued that take longer to be, or might take a while to be cashed. And this is a very common situation. Here we can see on our bank statement, for example, we've got all this activity here, down to this 4,500. That matches up. But then in our accounting records, we issued these last three checks for 400, 800, and 700, and so we reduce cash for that. Again, remember, right when the term is cut those checks, we write the checks, we put them in envelopes, send them out. Right when that happens, we reduce cash. The checks are basically treated the same as cash. But the way that they're going to get processed through the bank on the bank statement is, like I said, the recipient has to receive that check. They have to do whatever process they need to do, go down to the bank, deposit it, etc. And so this is just a timing issue. These will eventually be cashed. It's just going to take a little while for that to happen. And so it's taking a while. That's what we call these outstanding checks. And we have to reduce our bank statement balance by those to reflect the fact that if, in the perfect world, they just immediately reduced, there was no waiting period of mailing and recipient receiving and going down to the bank. If that had happened just immediately, then this is what the balance would be. We can see how it agrees to the book balance. And we can keep an eye on this as well. Like I said earlier, if you recognize an outstanding check that's been outstanding for a really long time, a month or something or longer, you might reach out to the recipient and say, hey, did you get this check? Why haven't you cashed it yet? Those kind of things. You could cancel the check at some point if it hasn't been cashed for a long time and reissue it. All those kind of things. This is a very common issue that arises because it does take, there's steps involved in terms of mailing the checks out and having them processed, etc. Okay, when it comes to errors, as we mentioned previously, there can be errors both on the bank side or on the accounting records, the books side. It really just kind of depends. You have to read the instructions of problems in this regard and compare them to see where is the error coming from, and did the error lead to the bank or the book being too high or too low, and then kind of correct for that essentially. So our example here says, when the bookkeeper received the bank statement, compared it with the company records, she noticed that the bank processed a check for $800 on June 8th, but the company has no knowledge of that check. So we can see here, June 8th, 800. One thing that looks weird, right? You can see, oh, check number 1, 2, and then it's 108. So I think what they're indicating with that is that this check should have been, it was accidentally assigned, to our account for payment, but there's a high likelihood based on seeing this that maybe that was an accident and it actually should be being pulled from a different bank account, essentially. And so to correct that error, we might want to contact the bank basically and do what we need to do to correct it. But on our bank reconciliation, what we're going to do is add that balance back because the bank is too low. Our cash balance is too low due to this $800 mistake. So our cash balance should be $800 higher, $3,500, which would agree to our book balance in this instance, and we'd be reconciled. So you kind of just got to take your time and look at these errors. You can also have errors on the book side. It's possible for us with our bookkeeping to make errors. So if the bank statement is correct, and here in this example, say that we discovered a check recorded as $950 in the ledger, but it should have been recorded as $590. We can see $590 is the right amount here on the bank statement, but we accidentally transposed the numbers to say $950. And so again, the way I like to approach these is I look at where is the error, and in this instance, the error is here in the ledger. And then I did we reduce our cash balance in the ledger too much or too little? In this instance, we reduced it by too much because the check should have only been $590. We accidentally reduced by $950. So really, to fix this problem, we need to find the difference between those two numbers, $950 minus $590. And then we need to add that difference back into the book side in order to accurately get the ending balance to reflect the $590, not the $950. So the difference between those two here, you can see, as they've shown it here, is $360. So we need to add back $360 to our book balance because we made the error in the books. And there you can see it being corrected. And as with anything on the book side, we're going to need to do a journal entry. And so in this instance, we are going to, and we're assuming the original check was written to purchase inventory, for example. And so we're going to increase cash. This is an addition to get our cash balance to come up. And then we're just going to offset that with merchandise inventory, which was the account originally used to record this transaction. Okay, so then as a summarized deal here, and this is kind of a nice breakout of all the different types of interest earned. Are we adding to the ledger balance? Are we subtracting from the ledger balance? And when we say ledger, we're saying the balance per books. Anything on the books side, you see these asterisks mean we need to create a journal entry. And these are all the things that could be happening, essentially. As far as on the bank side, we've got outstanding deposits, outstanding checks, and then bank errors to consider. But those don't require any journal entries because our books are right. It's not an issue with our accounting records being wrong. It's just that there's either an error that needs to be corrected and that on the bank side, or we need to just wait until these outstanding deposits or checks just clear the bank, and that just takes time. So you can see something like this. This is all of these things kind of added together. So you'll have the bank statement side, and if we have outstanding deposits, we've got outstanding checks, and then on the book side, we've got some electronic deposits, some electronic payments maybe that happen automatically, some bank service charges. So there's a whole host of things that actually show up when we've been reviewing these examples of the different types of reconciling items. We've just been looking at them one by one, but in reality, usually the bank reconciliations will have a whole host of different various reconciling items to consider. One way we can do these bank statements, or sorry, the bank reconciliations, is just comparing the bank statement to the GL detail. And they've got these green check marks in here on both sides. And the process that they're doing here is going line by line and figuring out what's in the ledger that's not in the bank statement, and what's in the bank statement that's missing from the ledger, basically. So if we look here and say, okay, there was a check that was reduced our book balance by 140, then we look over here and say, oh, yep, here's that same check number 62. Yep, that agrees. So that one is recorded on both sides. And if they're on both sides, then it's not a reconciling item. But we see something like, the service charge down here doesn't have a check mark because it's not listed here. And keep in mind, I think you saw this in that first example, is that, again, when you write a check, maybe we wrote this check on October 2nd, but the check doesn't actually clear until October 8th down here. So it's not the case that the ledger activity is going to have the exact same chronological order as the bank statement activity. So that's why it's helpful to do these little checks or something of that nature, because you kind of have to go down and search for these things on both sides. It's not like they're just match up exactly, like I said, in chronological order. And so here's an example of a completed bank reconciliation. We'll work on this with a lot of in class and homework problems, so don't worry too much about the details, but this is what this is kind of look like. And then remember that our adjusted balance is $43.95 equal per the bank statement, per the books, and that's a requirement for an accurate reconciliation, is that the adjusted balances are equal. And then as we've seen, or as I mentioned, all of the things that happen on the book side, all the reconciling book side items need to be recorded with journal entries to actually record this accounting activity into the books. And so there you'll see something like this, where you've got all these different reconciling items on the book side, and they're all being recorded. One thing to keep in mind is they all have cash in them, and either increasing cash like here or decreasing in the rest. And that's really comes back to the fact that what we are comparing and adjusting is the cash balance. So that's why you see cash, cash. Every item is cash related. Okay, suppose $200 interest against a loan was deducted directly from your bank account and you did not record it, which is the following is the correct entry to record it. So we're just talking about interest expense and cash being reduced. So hopefully at this point you understand excuse me, the journal entry here for on letter C will increase expense, reduce cash. We saw that when we were doing our bank reconciliation, and that's what we need to record essentially. Here's the similar, or at least a similar type of problem here, but suppose principal was deducted instead of interest. And so again, we're crediting cash, $250, because we paid it. But now instead of debiting interest expense like we did here, this is loan, principal being paid. And so we're going to reduce the loan payable directly with a debit. So debit loan payable, credit cash. Okay, suppose you receive $220 interest from savings that was directly deposited. So now we're going to have cash going up. It was deposited. So now we're seeing cash increase and interest revenue, because that's what we received interest. Credit is an increased interest revenue. So it looks like B is the right answer there. If a customer deposits $800 to pay an invoice and they pay it directly to the bank, then we are receiving cash and we are reducing accounts payable. So again, looks like B is the right answer here. Oh wait, what did I say? Oh, I'm sorry. Not B, C, because we've received cash, we're going to reduce the receivable that customer was paying us. And yeah, sorry, I just got mixed up there on my payable receivables. We're going to reduce our receivable because we no longer need to receive this. We already got it. They just paid it directly to the bank, so we didn't know that we received it until we did the bank reconciliation process. Okay, and again, I say this a lot, but I think bank reconciliations are really one of those things that you have to have a lot of hands-on experience with to feel comfortable. So don't feel overwhelmed if you're just a little lost at this point. Hopefully you get some context when we start actually practicing some bank reconciliations, why we're doing them, what some of the goals are in terms of getting adjusted balances that agree and the related journal entries, etc. And we'll do lots of practice there. But let's talk about petty cash now. So the idea of petty cash is this concept that a lot of businesses will have a small amount of cash on hand in order to pay for certain things that require, that you need to buy in cash. And that this is becoming less and less as digital payments become more and more common, even for things like parking meters. You can pay with a credit card now, postage stamps, mail fees, etc. But you still might want to have some cash on hand at your business so that you don't have to go down to the bank all the time or issuing a check, every time maybe certain vendors will only take cash, for example. So in those instances, we can have a small amount of cash on hand, and we can set up what's called a petty cash fund to account for that. So there's an example. If a petty cash fund starts with 100, that is the maximum amount that can be spent. So when the account approaches the $100 limit, we refund it. So it's this, we set a certain amount, like it mentions here, when we say, okay, we want to just keep a small amount on hand, it's $100, and then as those funds are spent, as purchases are made with this cash, and that $100 starts whittling down, then eventually we'll go in, take more money out of our other accounts, get some cash out of the ATM and put that back into whatever it is. It's usually like a box or lock box where it's stored, but we'll put that and we'll call it petty cash fund essentially. And so the accounting for doing the petty cash fund, you would remove the cash from the cash account. Typically, this would be us, going to the ATM, for example, taking out $100, and then we're going to basically put that in a separate asset called petty cash, which is reflective of the fact that $100 of this cash is actually like dollars somewhere on site, essentially. Okay. So now we've got the petty cash fund set up. Here's a few important internal controls, because we still are dealing with, cash that's at the business that could just be, if it was just sitting out somewhere, somebody might walk by and steal it or something. So a few of the controls we should put around petty cash, even though it's a small amount, we should designate one individual as the petty cash custodian. So maybe it's into a safe somewhere, and that individual has the keys to the safe. We establish the amount of the fund here, and we record this initial transaction. So some additional internal controls. We should require that if someone's going to come and say, hey, I need to get some cash out of the petty cash fund to go buy some office supplies, for example, then we, the custodian, should say, okay, I'm going to, go buy what you're going to buy with the petty cash money, and then bring back a receipt, and we will keep track of those. And so here we've got a summary, kind of a petty cash analysis. Again, we can have that issue of cash over and short, essentially, like we did with the registers. Previously, we talked about cash registers could have some errors. These petty cash, box, could, the cash going in and out of that thing can also have some errors. So Here we've got our opening balance. We keep track of all the payments that were made with individuals taking money out. And then we realize that we somewhere missed $2 of disbursements that happened, or there was an error or something. So that basically gets us to balance. And if we're down to $15 essentially left in the petty cash fund, that's what we're basically saying here is $85 has been taken out. Then we can go back to the bank, get 85 more dollars, and then go put those into the petty cash fund to bring that balance back up to an actual $100 that's there. So then as far as journal entries go, so we've done the first journal entry to establish the petty cash fund, and then all the receipts are being placed into the box as the cash is being used. And then eventually we look at those receipts once the cash is getting sort of low in there. We have the custodian tell us, hey, I need to replenish the petty cash fund. And so then we look at all of these receipts and we are able to debit the expenses related to all those different payments. So we have gas, office supplies, delivery expense, parking expense, etc. We also debit that cash over or short. There's some miscellaneous issue error that happened. We don't know what it was, but it's small dollars. We're not too worried. And then we credit cash, which is basically to say we're taking out the money from the ATM, like we said, or from the bank, and replenishing this lockbox, for instance, replenishing the petty cash fund. And so when we credit this cash balance, that's us taking money out, for example, of the ATM. So here's some example entries. So if this is us increasing the petty cash fund. So if we want to increase it high above the 100, for example, to 150, maybe because it's being used more than we thought or whatever, and we don't want to replenish it as often, then we're just going to do a similar entry like we did to establish the fund, but now we're just doing it for the amount that is to increase. So if we previously did an entry for 100 to establish, then the 50 increase to petty cash asset means that the new amount to maintain there is 150. And then it tells us, if on December 17th we replenished the petty cash fund, so we would put all this, if we're doing that at the same time that we increase the balance, then we have all of these expenses based on the receipts in the box. We've got some unknown cash shortage, cash over and short amount to get it to balance, and then we're recording an increase to the actual petty cash fund of $50. And then to do all that, we're going to take out, we need $135 because we only have $15 left in there now, essentially is what we're saying. And so if you add in this 135 to the current 15 that's sitting in the safe, that's going to bring us up to 150, which is what we want. And then you can see you can use a spreadsheet to track the petty cash, and not a bad idea. We can organize the receipt numbers, say what the amounts were by the different types of accounts, and that's a way to easily do the journal entries later, and also to track the ongoing total of how much money is in the petty cash fund, so that when it starts getting low, down to whatever, $15 in our instance, that's a trigger to us to say, oh, we need to go down to the bank, we need to go pull some money out of our normal account and bring back that cash to just put it in this safe that we have on site for these small types of purchases. So these are just all the internal controls type stuff. We want to establish some guidelines, maintain documentation, whether that's a spreadsheet, maintain the receipts for sure. Make sure employees understand what is to be used, how to use the petty cash fund, how not to use it. Establish responsibility for petty cash with one person, and then periodically count the money in there to make sure that we're not missing something in the records, essentially. And so you can see, and I guess underlying this whole discussion is the concept that the petty cash fund is just cash on hand, if you want to think of it that way. And companies underneath the overall umbrella of cash and cash equivalents, for example, we can have multiple bank accounts. We can have the petty cash fund, which is money on site. And then we've got cash equivalents, which is maybe some kind of short-term investment, for example, so on and so forth. Actually, let me look up what an example of a cash equivalent to be, because I don't want to. Usually, short-term investments are in their own line item, but let's see. What would the example? So, yeah, really short-term investments. Money market funds, for example, certificates of deposit, CDs that mature in 3 months or less, etc. So it is just a really flexible form of, if you have investments that can be turned into cash within a relatively short period of time, we can call those cash equivalents and list them in this manner, essentially. Okay, so what type of items are paid for using a petty cash fund? Remember that these are going to be small purchases, not illegal expenses, not company expenses that require a check, obviously, because we're paying for these in cash. All company expenses, no. These are just for small amounts, so D is the answer there. Who's in charge of the petty cash, or what are they known as? And petty cash custodian is going to be the title that we give to whoever's in charge of ensuring that the petty cash process and the money and everything is being handled appropriately. Okay, so now we're at the end of our lecture here, and so we'll do a summarization of the primary concepts we talked about. We talked about first how important internal controls are and how they're not just necessarily an accounting concept. They're a business-wide concern. You need controls in all areas of business. A lot of times accountants and the finance and accounting departments kind of get tasked with ensuring that internal controls exist, because the financial impact is really important, and so the finance and accounting people kind of get tasked with that. But it is a business-wide concept that needs to be applied across all processes, not just journal entries and financial statements, etc. Cash controls specifically are very important because cash is very susceptible to theft, and so we want to make sure that we're implementing things to ensure that doesn't happen, like storing cash in a secure place, making regular deposits, authorizations for payments. So outgoing cash should have invoices and approvals underlying those payments. Take advantage of discounts if they're offered. So that's kind of just an error that might happen, or I don't even know if I want to say an error, but a missed opportunity for discounts if you're not taking advantage of those. And then using this over and short cash tracking account is important, especially if the business has cash registers and they're collecting money, that we can use this account to reflect any discrepancies that we see in the records versus what the actual cash balance is. And the reason those errors or those discrepancies are arising is because of just human error when handling cash, working at a cash register, etc. We talked about preparing bank reconciliations and the related journal entries. And remember, what we're doing with the bank reconciliation is taking the balance for the general ledger and the balance for the books and comparing those, and then identifying all of the specific differences between those in order to understand what the differences are. And then when we have differences related to items on the bank side that need to be recorded, we do journal entries that are a necessity in order to update the general ledger records to be accurate and reflect all of the transactions that have happened, even if they're things that just occurred at the bank payment of bank fees, for example. And then we talked about the petty cash fund, how to prepare that, and some of the journal entries there. And so the overall concept, remember, with petty cash fund is just some cash on hand, probably in a safe at your business office, to be used for small incidental expenses. We have a custodian who is the gatekeeper for accessing those funds. There's a requirement to bring receipts back, and then we track the receipts and the amount of the cash in the petty cash fund. And when the cash starts to get low, and we can replenish the petty cash fund, and we record all of the what was that money used for at the time that we do that replenishment. So if it's for parking, we record some parking expense, and if it was for postage expense, so on and so forth. And that's how we do the accounting for our petty cash fund. All right, well, that brings us to the end of our lecture for Chapter 7. We'll do lots of practice with bank reconciliations and some with the petty cash. And then the concept, it's more conceptual when we're talking about internal controls and some of those things. So you'll have some of those multiple choice questions related to those kind of concepts on quiz or an exam. But you should have a study guide for that exam that will point you in the right direction to make sure that you're studying the right amount and the right topics to keep you focused there. All right, well, thanks everyone. Appreciate you all following along. Hope you're having a good day, and I will talk to you all soon. All righty, bye.